Investing can feel complicated when you first start. Stocks, bonds, mutual funds, index funds, ETFs, and for many Canadians, the first question is simple. What exactly is an ETF? ETF stands for Exchange Traded Fund. The easiest way to understand an ETF is to imagine a basket of investments. Instead of buying just one company's stock, an ETF allows you to buy many investments all at once. Inside that basket could be dozens, sometimes hundreds, even thousands of different investments. For example, one ETF might hold the largest companies in Canada, banks like RBC or TD, energy companies, railways, telecommunications companies, technology firms. When you buy one share of that ETF, you are instantly investing in all of those companies together. This is one of the biggest reasons ETFs became so popular. They make investing simpler and more diversified. To understand ETFs better, it helps to understand why they were created in the first place. Years ago, most everyday investors used mutual funds. Mutual funds pool money from thousands of investors and invest it in stocks, bonds, or other assets. But many mutual funds came with high fees. In Canada especially, mutual fund fees have historically been among the highest in the world. Some mutual funds charge 1.5% to 2.5% per year. That may not sound like much, but over 20 or 30 years, those fees can eat away a significant portion of your investment returns. ETFs were designed to solve that problem. Many ETFs simply track an index instead of trying to beat the market. For example, an ETF might track the S&P 500, which represents 500 large U.S. companies, or the TSX Composite Index, which represents many of the largest companies in Canada. Instead of trying to pick the best companies, the ETF simply owns them all in the same proportions as the index. Because this approach is simpler, ETFs usually have much lower fees. Some ETFs charge less than 0.1% per year. That's one of the biggest advantages. Lower costs mean more of your money stays invested and compounding. Another thing that makes ETFs unique is how they are traded. Mutual funds are usually bought through a bank or financial advisor, and they are only priced once per day. ETFs work differently. They trade on the stock market just like regular stocks. This means you can buy or sell an ETF through a brokerage account. Examples of Canadian brokerages include platforms like Wealthsimple Trade, Questrade, or the investment platforms offered by major banks. During market hours, ETF prices move throughout the day, just like stock prices. For many investors, this makes ETFs flexible and easy to access. There are many different kinds of ETFs available today. Some track entire markets, others track specific sectors. Some focus on dividends, others focus on growth companies. Here are a few common categories Canadians often use. Market Index ETFs. These ETFs track major indexes like the Canadian market, the US market, global markets. They provide broad diversification in a single investment. For example, one ETF might give you exposure to thousands of companies around the world. Dividend ETFs. Some ETFs focus on companies that pay consistent dividends. These are popular with investors looking for income, especially retirees. Dividend ETFs often hold banks, utilities, telecommunications companies, and other stable businesses. Bond ETFs. Not all ETFs invest in stocks. Some invest in bonds, which are generally considered more stable than stocks. Bond ETFs are often used to balance risk in a portfolio. All-in-one ETFs. In recent years, some ETFs have become even simpler. These are called asset allocation ETFs. Instead of just holding stocks, they hold a mix of Canadian stocks, US stocks, international stocks, and bonds, all inside a single ETF. These are designed for investors who want a simple, one-fund portfolio. Why ETFs are popular in Canada? There are several reasons ETFs have become extremely popular among Canadian investors. 1. Diversification. With one ETF, you can invest in hundreds or thousands of companies. That reduces the risk of relying on just one or two stocks. 2. Low fees. As mentioned earlier, ETFs often charge much lower fees than traditional mutual funds. Over long periods, this difference can have a huge impact on investment growth. 3. Simplicity. Instead of researching dozens of individual companies, many investors simply choose a broad market ETF. This approach allows them to focus on long-term investing instead of constant trading. 4. Tax-efficient accounts. In Canada, ETFs can be held inside registered accounts like TFSA, Tax-Free Savings Account, RRSP, Registered Retirement Savings Plan. Holding investments inside these accounts can make your portfolio more tax-efficient over time. Are ETFs risk-free? It's important to understand that ETFs are not risk-free. Because many ETFs invest in stocks, their value can still go up and down with the market. During market downturns, ETF prices can fall, just like individual stocks. However, diversification helps reduce the risk compared to owning only one company. Many long-term investors accept these short-term ups and downs as part of building wealth over time. Final thought. For many Canadians starting their investing journey, ETFs have become one of the simplest ways to enter the market. They provide diversification, they keep fees low, and they allow investors to participate in the growth of markets around the world. Instead of trying to predict the next winning stock, many investors focus on something simpler, owning the market itself. And that simple idea is exactly what ETFs were built to do.